To keep you updated on the capital and financial markets, here is a recap of what happened.
BlackRock has warned that surging energy costs and higher valuations mean European equities are no longer the attractive bet they were just a few months ago. Helen Jurel, International Chief Investment Officer for Fundamental Equities at the $13.9 trillion in assets firm, said the economic hit from high oil and gas prices, as well as a shrinking gap in valuations with U.S. stocks after strong relative performance in recent months, means she has reined in her recent optimism on European equities. "You can't make these big proclamations that Europe looks cheap now," she added. "A year ago you had this really interesting valuation gap. The valuation gap has closed, and from an energy perspective, Europe is just a lot more exposed. So we are having to be a bit more selective about where we see opportunities." Several insurance companies have explicitly barred their agents from engaging in or promoting cash trust schemes as regulators step up enforcement of these products, which are often marketed with the promise of high or guaranteed returns. Internal circulars issued across the industry show what looks like a coordinated move to prohibit agents from offering cash trust schemes amid growing regulatory concern about their legality, structure, and potential risks to investors. These circulars, cited by The Edge, reflect a shift from general caution to firm restrictions as the Securities Commission Malaysia begins to assert its oversight on a segment that has long been in a regulatory grey area. Malaysia's Private Retirement Scheme or PRS membership increased to more than 680,000 as of end March from 671,000 at the end of last year, though assets under management dropped to 8.6 billion ringgit from 8.8 billion ringgit amid the war in the Middle East. Sharifatul Haniza Said Ali, Executive Director of Securities Commission Malaysia, announced the figures in her keynote speech at the Private Pension Administrator Fund Awards. She said the decline in assets managed by PRS funds reflect broader market movements in recent months since the Middle East conflict erupted. China's national team has stepped back from its dominant role in the country's biggest stock ETFs, pointing to efforts to rein in an overheated rally earlier this year. Central Huijin Investment Limited, a unit of China's sovereign wealth fund that leads a group of state-backed investors used to stabilize markets, cut its ownership in several key exchange-traded funds to below the 20% disclosure threshold, according to first-quarter filings. Its current stake is unclear. The disclosures offer the clearest confirmation yet that the national team cut a substantial portion of its ETF holdings in January, as turnover hit a record and the rally turned increasingly speculative, particularly in parts of the technology sector. They also indicate Beijing is no longer just propping up the market but is willing to drain speculative excess, a break from past rescue playbooks. A major source of uncertainty stems from the Iranian blockade of the Strait of Hormuz. Roughly 20% of the world's oil and gas supply passes through the strait. As such, a prolonged closure of the Strait of Hormuz could lead to a huge shortage of energy supplies. While some investors see parallels between today's crisis and the Middle East oil shock in the 1970s, Hakan Kaya, a managing director and senior portfolio manager at the asset management firm Neuberger Berman, says today's market turmoil is unprecedented. Even though the blockade has pushed Brent crude to over $115 a barrel, any recovery will be slow. For instance, Iraq's oil production collapsed during the 2003 war. Kaya says it took about a decade for oil output to return to prior levels. The same thing has happened to Libya and Syria, whose oil levels have never returned to their original levels following the collapse of their governments. One should not assume that oil prices will go up forever, he adds. Businesses will eventually cut down and moderate their oil consumption. At some point, oil prices start to act like a consumption tax. Demand begins to erode, economic activity slows, and the price itself becomes the mechanism that restores balance. Read the latest issue of the e-Zine available at FIMM's official website to stay updated about what's going on in the industry. Watch the latest episode of Coffee Talk to find out about what is going on in the industry, exclusively on FIMM's official YouTube channel.
This has been the FIMM TV Weekly Recap. Be informed, stay updated, be sure to like, share and subscribe.